Alright, welcome ladies and gentlemen to Lesson 1, Managerial Accounting Basics. In this lesson we're going to learn the basic concepts of managerial accounting and the role of management within an organization. We're going to go through the differences between managerial and financial accounting. We're going to understand the different cost components used in management accounting, and we're going to prepare a schedule of goods manufactured. Alright, let's start. I need you to have Lesson 1 cheat sheet in front of you. Turn to the side that says Concepts and Definitions. We're going to start there. We're going to start right in the middle. There's a flow chart, 4 circles with arrows. That flow chart, at the top of it says Managers carry out the following activities. And we're going to understand exactly what management does within an organization. Alright, the first thing that management does is planning. Management sets short-term and long-term goals, and they set strategies, or they come up with strategies on how to achieve those goals. You know, plans usually take the form of budgets, and that's where we get into accounting and the role of management accounting and managerial accounting within an organization, right? The management accountants set the budgets. Very exciting stuff, I know, but that's what you need to understand. That's how the planning goes. All right, now the second step they do is organizing. Accountants or management organizes the necessary resources to carry out the plans or the budget. The plan that they came up with. They need to organize people, raw materials, if they're a manufacturer, all the things they need to carry out the budget or meet the budget, they need to organize. So that's the second step. Third step is direct. They need to take actions to implement the plan while motivating others to achieve results. So directing or leading or motivating, that is, okay, they've come up with a budget, they've got the resources, the people, the raw materials, so now they need to motivate those people, they need to get those people excited, just like I'm trying to get you excited about accounting. They need to get those people excited about taking out or achieving that plan. Alright, so that's the third thing. Now going to the fourth bubble, control. It's not necessarily controlling somebody where you have total control over the actions. It's more monitoring or seeing how we're performing to the budget or to the plan. And so that is, how do they do that? They compare actual results to budget by reviewing performance reports. They take corrective action and adjust future plans. And as you see, the next step is planning. So we're controlling, we're monitoring, and we're saying, how are we doing? Okay, well, now we need to come up with a new plan because we didn't do so well, and that's where we get back to the start, where we're planning again. We're setting new short-term goals, new long-term goals based on the activities that we carried out. All right, so that's the role of managers, and that's really that. This flow chart, these 4 functions, we're going to see it throughout all of our lessons, so it's a very key concept. Make sure you understand how this all flows and the role of management. Now, moving on to the, if you look to the top left of that cheat sheet, there's up here there's a chart that says differences between financial and managerial accounting. Now, those of you who took my financial accounting course will understand that financial accounting was a lot about journal entries, preparing balance sheets, income statements, statement of retained earnings, statements of cash flows for other people to look at, for external investors, for the banks, people that are going to loan us money, people that are going to give us money. So it's all external. All right. Really, the main difference is that management accounting or managerial accounting is more internal. It gets back to the function, the 4 roles of management is planning, organize, direct, and control. Those are all internal activities. Managerial accounting is internally focused. So we're going to go through the 7 key differences that we've identified here. The first one is the users. Financial accounting users are external persons who make financial decisions. Users of managerial accounting are managers, employees who plan for and control an organization. Just like we went through in this flow chart, that's the managerial accounting. They take the information and they carry out the planning, organizing, directing, and controlling activities. That's number 1. Number 2, it's the focus. Is it historical or is it future? Financial accounting is historical. We have a balance sheet as of a certain time, which is usually a previous date. We have an income statement for a period of time, which is usually it has to be a previous period. So that's historical. Now, if we're talking about managerial accounting, we're talking future emphasis. Remember, what the first thing they're doing is planning. They're setting budgets, planning for the future. Management accounting, managerial accounting is for future events. That's their focus. Okay, back to the chart number 3, verifiability versus relevance. Financial accounting is the emphasis is on verifiability. And if you took the financial accounting course, verifiability means that we're able to trace the information in the financial statements to external documents to corroborate that information. So we're more interested in verifiability of the external financial information in financial accounting, whereas relevance, for managerial accounting, we want the information to be relevant for planning and controlling, right? The part of the functions of management. We want the information to be relevant and timely so that we can plan and control and take corrective actions. The fourth thing is precision versus timeliness, and I kind of covered this in the first one, or in the previous one, but the emphasis for financial accounting is precision, because this is going to external parties. We want precise information because they're going to make decisions about investing and lending. So we want that information to be precise. Managerial accounting, more emphasis on timeliness, because we're trying to make decisions, we're trying to plan for the future, we're trying to plan for next week, we're trying to plan for next month, trying to plan for next quarter. We need the information to be timely. Number 5, subject versus level of detail. So for financial accounting, the primary focus is on the whole organization, right? The whole balance sheet, the consolidated information, whereas the managerial accounting, the focus is on segments, regions, products, because we need to break it down to the smallest component, because we're going to make better decisions about future if we have the most granular, most disaggregated information as possible. And so the focus for managerial accounting is more on segments, regions, products. It's broken down, it's sliced and diced. You're looking at budgets, you're looking at actuals, but you want it at the smallest level so that you can make accurate and timely decisions. 6, nature of information. Financial accounting needs to be GAAP, it needs to be objective, it needs to be reliable, it needs to be historical. Managerial accounting doesn't need to be GAAP. It's subjective. It depends on what management monitors and what management looks at. It's relevant because it's timely and it's future oriented. 7, the requirement versus frequency, right? So financial accounting, it's mandatory for a period. Remember, if you guys took the financial accounting course, if they're a public company, the SEC requires them to file quarterly, annual statements. If you're lent money by investors, banks, sometimes they require you to create external or financial statements that for external use. So those financial accounting is more required, whereas managerial accounting is not required, but it's prepared as needed. Real time, day to day, weekly, monthly. It's prepared as management needs it, as they deem necessary to monitor and plan for the organization. Alright, going on, we're going back to the top right. We're going to get into some cost definitions and exactly understand what costs are when we're talking about managerial accounting, because managerial accounting is really focused on taking cost, analyzing them, putting them into budgets, putting them into inventory. So let's understand cost. The basic concept, cost is the value of what is given up during exchange of money or time for something else. So the cost of something, when you go to a store and you buy a product, say you want to buy a camcorder, you go into a store and you pay $500 for that camcorder. Well, that is the cost to you for that product. You're taking your money and exchanging it for something else that somebody else created, so that $500 is the cost to you. Well, management, they buy raw materials, they hire people, they pay them wages, they pay rent. What the cost they give up, the money they give up in exchange for those services, those raw materials, that rent, that's cost. Right? It's important. It seems kind of basic, but it's an important concept to understand as we go through all of our lessons. Cost definitions. An opportunity cost is a potential benefit that is given up when one alternative is selected over another. An opportunity cost. So you're sitting here studying and instead of going out and partying with your friends. That is an opportunity cost. You could be out with your friends having fun, or you could be here listening to me not having fun, but hopefully the opportunity cost, you give something, you exchange something, and hopefully you'll get a better grade. So the opportunity cost is you sacrifice going out with your friends, and you're here watching me talk about boring accounting. Sunk costs. A sunk cost is the cost that has already been incurred and that cannot be changed by any decision made now or in the future. A sunk cost, okay, you're watching me, you've purchased the Sharp Learning Curve Managerial course. That's a sunk cost. You paid for that. Now, your actions going forward are not going to affect that. Whether you watch all these lessons or not, you've spent the money. Thank you for that. But I'd encourage you to watch all the lessons because it will help you get a better grade. It will help you understand managerial accounting more. But that's a sunk cost. You've already paid for it. It's gone. It's not going to affect any future. There's no future cost, or it shouldn't affect any future decision in terms of cost. An out-of-pocket cost involves an actual outlay of cash. You paid for this course. That's an out-of-pocket expense. Cash actually went out the door. A relevant cost is one that has potential to influence a decision. A cost to be relevant, it must be both of the following: differ between two decision alternatives, and be incurred in the future rather than the past. All right, so relevant cost is one that has the potential to influence a future decision. Okay, so the relevance of you getting a better grade or you understanding managerial accounting, it's hard to put a cost on that, but it's relevant, right? So understanding that managerial accounting so that you can get better grade in your managerial accounting course, that may not have an actual dollar value attached to it, but it's a relevant cost because it was part of your decision that you made when you purchased this course, right? It was relevant. You can't put it, well, I try to put a dollar value on it because you paid for the course, a certain dollar amount, but the relevance of the benefit, it's hard to put a dollar value on, but it's relevant. Anyway, we're going to get into relevant costs in a later lesson, but understand that it has to have two things. It has to differ between two decision alternatives. You could have paid for this course or not paid for the course, and it needs to be incurred in the future rather than the past. You're going to pay for it in the future, or you're not going to pay for it in the future. It happens in the future. An irrelevant cost is one that will not influence a future decision. You know, whether you like your professor or not, whether he's good or not, that's irrelevant because you're going to want to get a good grade. You're going to want to understand managerial accounting. How your professor performs is irrelevant. Anyway, irrelevant. It doesn't have any effect on what we're going to do in the future. Next cost definition, variable cost. Cost changes when activity levels change. All right, we're going to get into that. Well, there's some graphs down here, but understand a variable cost changes when activities level change. A fixed cost remains unchanged when activities levels change. Fixed, it doesn't change. Variable, changes. It's variable. Next, we're going to come to over here in the middle left, and we're going to get a few more cost definitions. Cost object. A cost object is anything for which cost data are desired, including products, customers, jobs, organizational subunits, etc. For purposes of assigning cost to cost objects, costs are classified two ways. There's direct costs and indirect costs. Direct costs are costs that can be easily and conveniently traced to a unit or product or other cost object. Examples of direct costs are direct materials and direct labor. Indirect costs that it cannot be easily and conveniently traced to a unit of product or other cost object. An example of indirect costs is manufacturing overhead. All right. What's direct labor? What's direct material? What's manufacturing overhead? Well, we're going to get to that right now, but just understand that a direct cost can be directly traced to a product. An indirect cost cannot be directly traced to a product. So you can directly trace the cost of your books and whatever else you need to buy for a class, pens, paper. Well, so you can directly trace the cost of a book to your class, but you can't directly trace the cost of the pens, papers, computer that you need for all of your classes, right? So say you bought a computer, well, that's going to benefit all of your classes. So that's sort of an indirect cost of going to school, whereas the cost of your accounting book, it can be directly attributable to your accounting course, so that's a direct cost to the accounting course. Whereas, like I said, pens, papers for taking notes, laptop for doing your homework, that cannot be traced directly to that accounting course. So we're going to get into more examples throughout managerial accounting, but those are concepts you need to understand. All right, manufacturing costs, we're right here in the middle. Manufacturing costs are usually grouped into three main categories: direct materials, direct labor, and manufacturing overhead. Wow, we just talked about those, direct and indirect costs. Direct labor, direct materials, and manufacturing overhead, those are the three main categories of manufacturing costs. Direct materials, here's the definition, are raw materials that become an integral part of the finished product